Hello and welcome back to the channel. Back today with another stock analysis, and this time we are going to be analysing Apple and coming up with an intrinsic valuation for Apple stock and the expected rate of return. Our aim in this video is to find out whether Apple stock is still a buy in 2021. So in order to know that, we have to come up with an intrinsic value, like I say, and an expected rate of return to see if it is currently undervalued or around its fair price and above our minimum rate of return, which is 15%. To do so, I will be creating a valuation model from scratch. Here is our video agenda. We are going to first analyze Apple stock and its market valuation to just get an idea of how well it's priced. Secondly, Apple's financials and 5-year performance. We're going to take a look at that and see how well they have performed over the past 5 years. Then we're going to talk about a 5-year forecast for Apple and my potential investment thesis and what sort of catalysts I see in the near to medium term for Apple. Lastly, we're going to come up with an intrinsic valuation and expected rate of return from $133 per share, which is the current price. I'm going to give you 3 different scenarios so we get a wider idea of how well it could perform over the next 5 years. If you haven't already, be sure to subscribe to the channel and click the notification bell so you can see more investing and analysis videos such as this one. If you enjoy the video, I also please ask you leave a like, as it helps the channel out greatly. Now, Apple stock has been on a very, very good run since sort of mid-2020 last year after the coronavirus outbreak. And to be honest with you, it's at 36 times earnings at the moment, which is the most expensive it has been in a very long time. We've got a 5-year chart here. It was back at 10 times back in 2016, now up at 36 times, which makes for a market cap of 2.25 trillion, which is quite astounding, to be honest. I really couldn't have pictured a stock worth 2.25 trillion 5 years ago. And they just reported some unbelievable earnings with 100 billion in revenue in one quarter for the first time. We can see here sales for every single product category rose by a double-digit percentage point. And if we look at it by product line, and we'll get into the product lines in a moment, we can see revenue up 20% year over year as a whole, iPhone revenue up 17%, services revenue up, which is the most profitable part of the business, 24%, other products like their wearables up 29%, 20% for the Mac, and then 41% for even iPad revenue. And to top it all off, gross margins improved to nearly 40% from 38%. So a fantastic quarter for Apple. Didn't really move the stock though whatsoever. I mean, it's up 2% today. I think it actually dipped on earnings when they came out slightly. But anyhow, I think all of the good news is obviously priced into this stock at this point at almost $2.3 trillion. Unfortunately, it's in a position where good earnings don't move the stock much anymore. Just to give you an idea of the makeup of Apple and where all the revenue is coming from, iPhone really does dominate the revenue with 137 billion in the most recent year. Mac, iPad and wearables make up a smaller part of the business, but you can see some growth in the iPad revenue here, going from 18 to 23 billion in the space of 2 years, which is good. But this is what gets investors more excited. The services and subscriptions part of the business becoming a bigger part of the total revenue. And the reason why is because this is the highest margin part of the business. We can see around 16% year-over-year growth for the services segment of the business, which is very positive. And I'll tell you why. We can see that the hardware part of the business, or the products area, only generates a 31% gross margin, whereas the services and subscriptions area has a 66% gross margin, which is a lot higher. And that will bring that average to 38% as of the past year. And the reason that people get excited about it is that as services start to become a bigger part of the total revenue, that gross margin overall will creep up, and Apple should become more profitable. And then you'll see higher bottom line numbers as well. Okay, let's jump into the financials for Apple. Just get an idea of what the financials look like, why Apple might have been so appealing over the past 5 years. And it's an interesting one because you can see growth's not been exactly parabolic. It's not been really big at all. 3.5% top line growth averaged over the past 5 years, gone from 215 billion to 274 billion. Dipping in between. EBITDA has only grown 10% from 2016 to now. Averaged a margin of 30%, so very profitable company, generates tons of cash. I mean, those EBITDA numbers are huge. And then net income and EPS, this is where you start to see where some of the value of being an Apple shareholder is. So the net income has grown slightly, yes, 45 billion to 57 billion over the period, but it's not huge growth. But EPS growth, you start to see how earnings per share does affect the stock price, and a lot of the buybacks that they're doing contribute to this. So earnings per share went from $2 per share to $3.28, and it's not a huge growth rate, but still 9%. So, a lot bigger than that top line growth and EBITDA growth that we see up here. And like I mentioned, this is because they buy back so much stock. I mean, you can see here 22 billion shares outstanding, and that's dropped to 17.5 billion in the space of 5 years. So they're buying back anywhere from 3.5% to 4% per year. I think they spent over the past year or so 80 billion, I'll get the number, 80 billion on stock repurchase, which is just remarkable, to be honest with you. And no wonder it lifts the stock price. Free cash flow, a very, very cash-rich company. Free cash flow has actually grown quite a lot over the period, one of the better performing metrics. And you can see free cash flow as a percentage of net income tends to be a fairly reliable assumption of how much free cash flow we're going to generate over the period. Net income doesn't seem to vary at all. 21%, 22% sort of the margin that they get. Similar sort of thing with EBITDA. So I think really calculating the free cash flow here isn't going to be a hard thing to do at all. In terms of their balance sheet or a snapshot of their balance sheet, lots of cash, although a lot of debt as well. But I mean, when you're Apple and you've got a value of 2.2 trillion, who cares if you've got 98 billion of total debt, to be honest with you. Shareholder equity, this is a little bit disappointing to see. Equity dilution, 128 billion down to 65 billion in the space of 5 years. I didn't actually notice that before, and it's not something I like to see, to be honest with you, but just something to know, not something to get too worried about. And if you were someone who thought Apple's growth was done, or at least going to slow for the next 2 to 3 years, and I'm going to give you 5 quick catalysts for growth. I think over the next 5 years, we'll actually see higher revenue growth than we would have over the last 5 years. And the reason being is we've got first 5G and the increased demand for the new iPhone. This isn't just the new iPhone, though. The demand for all of their products is heating up just because of this 5G and tech and innovation revolution that we're going through at the moment. Leading into the next one, Apple's M1 chip. This could lead to big gains in the PC market. I mean, it's very well documented that Apple's M1 chip is a big deal in the sense that it dramatically improves the performance of the Mac. So we could see the Mac start to take some more market share of the PC market. Next, growth in subscription services, the highest margin segment of the business, and this will help lift the margins overall. Although Apple is still very profitable today and has been in the past, this could make their bottom line margins even better. I'll skip to 5 quickly, which is buybacks. We've seen they have done so many buybacks over the years. They spend around 70 to 80 billion a year on buybacks, and it really does help lift the stock. Really, it's been the main catalyst for the past 3 to 5 years with Apple stock, if I'm being honest. And then we had it fourth, but I'll do it last. The autonomous vehicles or Apple Car, so the entry into that market, which is a huge market and very hard one to break, but if any company can do it, then it's probably Apple. And it's hard to say what sort of financial effect this will have on Apple in terms of, how much revenue it will contribute to Apple, but I've got to say the total addressable market is very big and it could be a huge move for them. If you don't know any information on the Apple Car or Apple's entry into the EV world, then here is a quick clip explaining it all.
Multiple sources tell us that Apple is close to finalizing a deal with Hyundai Kia that would have Apple working with Hyundai Kia to manufacture an Apple Car at the Kia plant in West Point, Georgia. What we know from talking with our sources is that production is scheduled to start in 2024, though it could move out. It could be 2025, 2026. This would be an autonomous electric car, and most importantly, this would have Apple hardware and software. What does that mean? That means this would not be Apple software underneath a Kia model. This would be an Apple car in terms of what you sit in, what you experience when you're in the vehicle, both in terms of the shell of the vehicle, the interior of the vehicle as well, in addition to the software that drives the vehicle. And it's important to note here, the differentiating factor that Apple is driving towards is that it is autonomous. And that's important because Apple truly wants to conquer the last mile, the mile between where you are going and your home. Hyundai Kia brings to the table great manufacturing expertise. For Apple, it doesn't want to go out and just start building vehicles on its own. Could Apple right now find a plant somewhere start building electric vehicles, put some batteries underneath and say, here, we've got an electric vehicle? It probably could. It certainly has the resources to do that, but it wouldn't be a differentiated vehicle.
Okay, let's look at my forecast then. So I've got 15% growth going into 2021. Analysts actually have it at around 20 to 25, but I think 15's fair enough. I mean, they had a really big quarter, obviously. This one just gone, but I think they'll start to slow throughout the year, and 15's a bit more conservative in my mind. I've gone with 10% for the remaining 4 years, which is actually above analyst expectations, which is around 7.5%. So I guess that balances out, but I think 10% is probably fairer to go with. They do have a lot of tailwinds behind them going into 2025, and if we look at that revenue number, 462 billion, Apple are a huge company already, yes, but they appeal to consumers in such a wide variety that 462 billion number doesn't look too unrealistic when you compare it to the likes of a Walmart, and you think, Amazon aren't far off it now, with their earnings that they just posted. So 462 billion in 4 to 5 years shouldn't be a hard ask for them. Now, this is one of the numbers I want you to focus on, and I'll talk you through now. So even though we've only got around 10 to 12% top line growth, we can see that EPS is going up at a much quicker pace. And that's because I've put in that shares outstanding will be reducing at 3.5% per year with their share buyback program that they have. It's around 3.5 to 4% at the moment. I think that will continue. So we then see EPS growth of around 15.5% over the 5-year period, which, if we're going by some market theory, the stock price return will always be somewhat similar over a medium to long-term period to the earnings per share growth. So that is something to consider when you have a company like this that really is a cash-generating machine. They have a huge buyback program. Doesn't matter too much that they're not getting that really high top-line growth, because they can financially engineer the results. And we've seen it over the past 4 years with Apple. They've had somewhat satisfactory growth. I mean, it's not been high at all, the average being around 3%. EPS growth, though, has been around 9 to 10%, and we've seen the stock rise on it. As for my terminal values, I've got a market multiple method, which is 20 times EBITDA, which is a lot less than they're selling for now. So we're saying that premium is going to drop down quite a bit as we get to 2025, and earnings per share growth slows to around 13%. A perpetual growth method I have done as well, which is just a 2.5% growth rate into infinity. This actually gives us a higher number than the market multiple, just because their free cash flow at the moment is so high, and it's projected to be so high in 2025. And growth's already slowed quite a bit, so the fact that they drop down to 2.5% doesn't make a huge amount of difference, because it's going into infinity. And I've explained the perpetual growth method versus the market multiple in a different video, so I won't go into it in too much detail. Anyway, we average that out and we get 3 trillion as our enterprise value. And then we plus cash, less the debt, and then we get an average market cap of 3 trillion. And that should say 2025 here, sorry, not 2030. And that gives us a price target of $200 per share in 2025. Now, if we scroll down, on a 15% discount rate, which is my required rate of return, it gives us a share price of $120 per share as our fair value. And that is based off the estimated shares outstanding in 2025, not the current shares outstanding, which is why you'll see that intrinsic value in terms of the market cap looks so much lower than where we actually are as a share price, where $120, we're not far off that at the moment. I think we're at $137 per share. So you could easily see it drop to that. If we were using a 12% discount rate, as it is Apple, one of the safest stocks you could say, it's not going to implode anytime soon. Your biggest risk is that you buy it, it's too expensive, PE ratio starts to decline, and earnings don't grow as much, and you have a poor investment return. And that's really the only risk with Apple. You're not going to lose all of your money, that's for sure. So with a 12% discount rate, we actually get into fair value territory with today's price. $138 per share off a 12% discount rate, where you're basically accepting the required rate that matches the S&P 500 or thereabouts. But I'm going to stick with 15%, and that would really be probably my target price for Apple if I was to buy again. I mean, I've owned Apple a couple of times over my investing life, and selling it was probably one of the worst decisions that I made. But this might be one of the stocks that you look at and you think, I'm willing to take a low discount rate on it. I just want to own it in my portfolio. It's Apple. It's got quite a few short to medium term catalysts that might boost the stock. If you're looking at it from a long-term perspective, there's probably better places to put your money for a good long-term return. But if you did want to buy the stock, let's just look at what the likely scenarios would be. So your base case here, I've got 15% EPS growth and then a PE of 28 times, where we're doing 20 times EBITDA, so that would be around a PE of 28 times. The IRR is coming out as 13% over that time period. Isn't a bad return. It is a market-beating return, but I think this is the most likely case or return that you'd get from holding Apple over the next 5 years. We've got a bearish case, which doesn't look great, 3%. And that's based off a PE of 22 times and a 10% earnings per share growth. Worst case scenario actually shows that you lose money, although I think it's unlikely that this will play out. I don't think it will ever be selling for a PE of 20 times anytime soon, unless it does achieve really slow EPS growth for the next 5 years. We've got 5% there. Then you might see a situation like this. But like I say, not a bad company to own. Does have a lot of catalysts, near-term catalysts that will help lift the stock. However, I won't be buying. I will be looking for something else with a little bit more upside potential. Let me know in the comments below what you think of Apple. Will you be buying Apple stock? Do you already own Apple stock? Do you think it's going to be a winner over the next 5 years? If you enjoyed the video, I'd appreciate if you could leave a thumbs up and subscribe to the channel if you haven't already. And thank you for watching. I will see you in the next video.